Every day, banks make decisions that affect millions of people. Whether it's approving a loan, calculating the amount of capital they need to stay safe, or figuring out how much risk they're exposed to in the markets. But here's something most people don't realise. Behind nearly all of these decisions, there's a model running in the background. Now, these models crunch data, make predictions, and help banks operate efficiently. But what happens when a model gets it wrong? What if it misjudges credit risk, underestimates losses, or misprices a product? That's where model risk comes into play. It's the risk that a model leads to a bad decision because it was designed poorly, it was used incorrectly, or simply didn't hold up when the real world changed. In this video, we're going to explain what model risk is, why it matters so much in banking, how banks can manage it, and what happens when it's ignored. By the end, you'll understand why model risk is one of the most important and sometimes invisible challenges in modern finance. So what exactly is a model in banking, and why do banks rely on them so heavily? Well, let's start with what we mean by a model. In banking, a model is essentially a tool, usually based on mathematics, statistics, or machine learning, that's used to estimate something that's uncertain or difficult to measure directly. For example, a bank might use a model to estimate whether a customer is likely to repay a loan, or how much a portfolio of assets could lose if markets crash. Other models are used to value complex financial instruments, determine how much capital the bank should hold, or even automate parts of regulatory reporting. Now, these models take in data, things like credit scores, market prices, or economic indicators, and then apply some logic or formula to produce an estimate or recommendation. Now, these models are critical because they help banks make decisions consistently, at scale, and often in real time. Without models, banks wouldn't be able to assess thousands of loan applications each day, measure their risk exposure accurately, or comply with the detailed regulatory frameworks that govern the industry. But models are not crystal balls. They're simplifications of reality, and that means they can be wrong. So what is model risk, and how does it show up in banking? Well, model risk is the possibility that a model produces inaccurate results or behaves unpredictably, which then leads the bank to make poor or risky decisions. Now, this can happen in several ways. Sometimes the problem is in the model's design. Maybe the mathematical logic is flawed, or the model is too simplistic for the decision it's being used for. Other times, the issue is with the data. If the data is old, incomplete, biased, or just plain wrong, the model's output will be misleading, because no matter how good the logic is, it can't compensate for poor inputs. And then there's the risk of using the model in the wrong context. A model that works well in one economic environment might completely break down if inflation spikes, interest rates change, or customer behavior shifts. Now, that's especially true for machine learning models, which can pick up patterns in the past that don't apply in the future. So model risk isn't just about coding errors or statistical mistakes. It's about the mismatch between what the model thinks it's measuring and what's actually happening in the real world. So where in a bank does model risk tend to show up? Well, the short answer is almost everywhere. So let's look at some specific areas. In credit risk, models help determine whether a customer is likely to default on a loan. If that model is too optimistic, the bank might approve loans that never get repaid. In market risk, models estimate how much money the bank could lose if markets move in a certain way. If those models fail during a sudden downturn, the bank could be underprepared. In valuation, banks use models to determine the price of complex assets like derivatives or structured products. If those models are flawed, it could lead to big gaps between what the bank thinks something is worth and what it could actually sell for. In capital and liquidity, models determine how much capital a bank needs to absorb losses and how much cash it needs on hand to survive a stress event. These are essential to the bank's stability, and they rely heavily on models working correctly. Even in areas like customer segmentation, fraud detection, and anti-money laundering, banks use models to flag unusual patterns or classify behavior. If those models misfire, the bank might miss on real threats or flag innocent activity as suspicious. In short, model risk is everywhere a model touches a decision. And in modern banking, that's almost everywhere. So how do banks manage model risk effectively? Well, because model risk can have serious consequences, most banks have built dedicated functions to manage it. And this is usually called model risk management, or MRM for short. Now, the first key step is model validation. Every model needs to be independently reviewed and challenged by a team that didn't build it. Validators test the model's logic, assess its assumptions, and check that it behaves as expected under a range of scenarios. So they'll ask things like, does this model work in different market conditions? Is it too sensitive to a specific input? Has it been back-tested against real outcomes? And are its assumptions still relevant today? Banks also maintain a central model inventory which lists all the models in use along with their risk ratings, owners, status, and date of last validation. This helps ensure that every model is accounted for and monitored. Then there's ongoing performance monitoring. Even once a model is approved, it must be tracked regularly to make sure it's still doing its job. If performance starts to drift or the data changes significantly, the bank may need to recalibrate the model or take it out of use. Finally, banks put in place usage controls. For example, some models may be approved for internal use only, not for regulatory reporting. Others may come with limitations like only using them when volatility is low or not relying on them to make final decisions without human review. So what are the consequences of ignoring model risk? The impact of unmanaged model risk can be severe. At best, it can lead to poor decisions like approving risky loans, mispricing a product, or underestimating how much capital is needed. At worst, it can contribute to massive financial losses, regulatory breaches, or reputational damage. One of the most well-known examples is the London whale incident at JPMorgan in 2012. The bank used a model to estimate the risk of a portfolio of credit derivatives. But it turned out that the model had been tweaked in ways that made the risk look lower than it actually was. When markets moved, the bank suffered over $6 billion in losses and faced intense scrutiny from regulators. In other cases, poor models have led to biased decisions, such as denying loans to certain customer groups or incorrectly flagging customers as risky simply because of flaws in the underlying data or logic. So while model risk may sound technical, it has very real consequences for banks, regulators, and customers alike. So what's the big picture when it comes to model risk in banking? At the end of the day, models are not optional. They're essential tools that power modern banking. But like any tool, they can be dangerous when used without care. Model risk reminds us that no model is perfect, that every forecast, every calculation, every risk estimate comes with uncertainty, and that the job of a responsible bank is not just to use models, but to challenge them, monitor them, and always ask, what if we're wrong? Because in banking, when models go wrong, the impact isn't just theoretical, it's financial, operational, and sometimes even systemic. So here's a question to think about. If your job relies on models, how confident are you that they're being tested, challenged, and kept up to date? Let us know in the comments. If you found this video helpful, don't forget to like, subscribe, and hit that bell icon for more videos just like this one. If you're keen to learn more about finance, be sure to check out our courses on the industryportal.com, link in the description below. Thanks so much for stopping by, and as always, keep growing, keep learning, and I'll see you in the next video.